Hi, everyone. My name is Dean Rajan. I'm the Dean and the George Schulz Professor of Accounting at Chicago Booth. It's great to welcome so many of you here as we bring our alum Chelsea Stoner, General Partner at Battery Ventures, back to Booth for our first Distinguished Speaker Series event of the year. As you all know, the DSS is a long-standing tradition at the school. We bring high-profile leaders from business, from the government, from the community to the school to share their insights and experience. And sort of starting through the pandemic and since beyond, we've started to, sort of some of these events in person in Hyde Park, but many of them virtually to be able to get access to our incredible alumni all over the world. And we've had great chats with alumni like locally Tom Ricketts of the Cubs, Brian Nickel, who back then was CEO of Chipotle, now of Starbucks, Matt Maloney of Grubhub, and many, many others. We're really thrilled to invite today's distinguished speaker. So I'm going to just introduce her a little bit and then ask her some questions. We'll have open Q&A the whole time, so please feel free to submit your questions in through the Q&A box at the bottom of your screen, and I'll intersperse them with the questions that I have and the ones that many of you have sent in advance. So Chelsea is a general partner at Battery Ventures, which is a global tech-focused investment firm. Her focus particularly has been on investments in the software sector, and she's particularly interested in vertically focused SaaS companies, including in the healthcare vertical. So Chelsea has been named to the Forbes Midas Hot Prospects list of up-and-coming VCs, the Business Insider 23 Top Venture Capitalists in Enterprise Tech list, and Growth Cap's Top 25 Healthcare Investors list. Prior to Battery, Chelsea held positions with PE firm Key Principal Partners, with Accenture and Merrill Lynch. She has a BS with honors in chemical engineering from Northwestern, and of course, an MBA from Chicago Booth. So Chelsea also sits on the Northwestern Engineering School Board, the Booth Private Equity Council, and the Healthcare Technology Advisory Council for the Cleveland Clinic. Thank you very much, Chelsea, for joining us today.
Thanks so much for having me. Excited to be here. I'm honored.
So maybe we can just start with a little bit with your background. I mentioned that you started as a chemical engineer, which seems somewhat unusual for a VC growth equity investor. Maybe not. Maybe could you speak about chemical engineering, why that, and then how did you make the transition first to Booth and then beyond into the role that you have today?
Sure. I'm definitely not out of central casting for ventures, so it's a good question. I did study chemie in undergrad solely because I love chemistry and math. I grew up in rural Montana and probably didn't even know what chemical engineering was, to be honest. I did a lot of internships and figured out during undergrad, thankfully, that it wasn't something I wanted to do forever. So I did what any undergrad who doesn't know what they want to do does. I became a consultant. And so I worked it was Anderson Consulting at the time. This was going way back before they renamed to Accenture. And it was amazing. I loved it. I was able to travel the world, worked with some really interesting clients, solving some pretty interesting problems. And so I really liked that. But that's where I figured out, gosh, I need to get a finance education here to go farther. And I had no econ classes my entire undergrad, which is kind of crazy. And so I ended up at Chicago, which is great. Studied finance, and that's really where I fell in love with what I knew about investing. Like every case study, I just remember thinking, oh my gosh, this is so fun. It was like putting a puzzle together. And it was, for me, this really good combination of using my quantitative skills. I finally maybe didn't use my chemie degree, but certainly the problem solving and thinking about first principles and getting into data, that stayed with me forever. And so it was like this awesome marriage of my quantitative skills plus the people side that I thought I'd be missing in the lab if I had stayed in chemie. So long way of saying, I knew my first year of Chicago that I just needed to do whatever the heck I could to do investing on the back end. I didn't know if it was venture or private equity. Probably, I thought more private equity, and worked really hard to get myself positioned there. I held out until I think it was like a week before graduation is when I got my offer. A lot of help from Professor Kaplan and his network. So that was great. But yeah, that's kind of the history. And I will say my, chemie degree, again, while I'm not using it, the quantitative skills, I mean, that's really, I think about some of my best investments, and it really was very foundational in getting me to, look at the data in a different way, seeing things that others missed, which creates alpha. So that has been a kind of a sweet spot for me.
Mhm. So do you feel that having some technical knowledge, combining it with the business expertise in an MBA, that in some way is actually a good idea for somebody who wants to be an investor?
Yeah, I mean, for me, it was, there's, I think if you're already in this space, if you're already an investor and know that that's what you want to do, you've fallen in love. I don't know that you need to, build and go back and get an MBA other than for networking purposes. But for me, I was, a career changer, and it was just foundational. I mean, all the finance, I still use it today. All of the things that I learned. And so, yeah, I think it's a really good combination for me anyway, the engineering plus the business degree.
Could you speak about like the genesis of a deal, if you will, something that you're proud of, and sort of how it came about? What was sort of the time frame over which it came about?
Ooh, so I will say Battery, we're very thematic investors. So we are software mainly. About 90% of what we do is software. We're stage agnostic. So it means that we're looking at everything from pre-revenue, innovation, tech deals, all the way to more mature, maybe $100 million revenue buyout deals, and everything in between. And it's really kind of investing along the S curve of innovation and trying to figure out the right place from a risk return perspective to play a particular end market. So it doesn't necessarily follow the David Swensen model of investing, risk return. He likes to kind of parse it out, but it's worked very, very well for us as kind of our software expertise. So I give you kind of that backdrop in that we take very, very deep dives in particular areas. And when I first got here, one of the first areas that we went really deep on was the overall aging population and what sort of software and services should be sold to this growth market as the boomers came up in age. And we looked at this one kind of at the time was not a venture deal, let's say. It was a company, a software company, about really small, kind of 6 million in revenue, selling to the very small market of what's called durable medical equipment providers. So this is software that helped them run their businesses. Very, very small market. There's about 20,000 of them across the US at the time. And we went to our IC and said, we need to do this deal. And it was maybe a $200 million market. And in venture land, we don't look at markets that are less than 2 billion in total TAM, right? Because you need to do something big and meaningful. And so thinking about why I was proud about it is it was such a different way of thinking about it. And the idea was, look, if we can this was an opportunity to buy out one of the founders, where we were going to be able to own 70% of the business. And through all of our research, we figured out they were the leader in this cloud place. They were the only cloud provider, actually. And it was the understanding that they were going to get kind of the growth in the category leadership position. And if we owned 70% of this, even if it was just a $50 million revenue business at the end of the day, it was still a meaningful return to the fund. And so we should go ahead and do that. And so again, the IC thought it was kind of silly, but okay, let's go ahead and we'll try it out. Well, it ended up becoming one of our biggest returns. It was, again, like a private equity deal. It was a buyout deal. We owned the company. No buyout firm would have done the deal at the time, though. And we took it from 6 to 130 million in revenue and like 50 of EBITDA, and sold it for, over 30 times return. And so it's one of those things where, again, kind of looking at something a little bit differently than the rest of the market is really where you find alpha. And we've learned so much. I've learned so much from that deal along the way that has now, of course, applied to, all the other deals that I do. And so it's always looking for something a little bit different and being imaginative in that.
That's a great example. I mean, you mentioned the deep dive. In this case, this was the aging population. How many such teams do you have at any given time as a firm?
Oh gosh, a lot. We probably have, call it 20 to 25 things that we're going deep on at any given time. We're on our 14th fund. It's, roughly a $3.5 billion fund. There's 10 investing partners. And so there's a lot of us. Our total size of investment staff is 60 folks, a little over 60. So it's a pretty big team. So we're going deep, and we might spend 6 months on a particular area. We might spend 6 weeks, kind of depending on what we find.
And if you think about the SaaS sector in particular, right, it's evolved a lot, particularly with the growth of AI, which is something we can talk about. Just broadly, what are some of the biggest sort of changes that you have seen in investing, and where do you see things going forward?
Yeah, gosh, I go back to when I started here, which has been 18 years, which is crazy. I graduated Chicago 21 years ago. I don't feel that old, but it's been a ton of fun, and it's really flown by. But looking back to when I started, it was really the beginning of SaaS, right? The kind of beginning of that model and the real kind of takeoff of that. And so we saw that trend, and it's not played out yet. It's maybe in the 5th inning. From my perspective, so there's a long way to go there. But what we have seen is this decline in the cost of building apps. And that has enabled apps to be built in so many different kind of small. I gave you the example of Braintree, the durable medical equipment software company that could go after this small market. We're seeing apps built for $50 million markets, very, very small, because it's inexpensive to do, and you can still have a profitable company. And so I think, especially with put Gen AI on top of that, and we're going to see smaller and smaller, software players for little verticals along the way. I think we're going to kind of get away from this behemoth that we've had historically of these large horizontal players. And so that's interesting. I think there's a lot to invest in around there. Certainly with the shift of AI, that is huge and very important. I think, frankly, it's very, very early, and we're all trying to figure out, who the winners are going to be. I think, we've already seen some that have kind of petered out. We thought were really, interesting rocket ships, and sure enough, they're, decelerating as fast as they accelerated. So that's always interesting, and it's a bit humbling when you see that. But yeah, very early days, but I think it will be really, really massive. And so I think those two things together just lead to the further proliferation of software into every little nook and cranny of society. So yeah, it's certainly an interesting time to be an investor.
Well, so let me go back to one of the things you mentioned in the beginning, that you as a company, you're age agnostic about who you invest in. Is that generally true for other firms like you, or why did you adopt that particular position?
Yeah, it's more of a kind of a reflection of just how flexible the firm has been from the beginning. So most firms, I'd say, are, they're either early stage or they're growth stage or buyout. Those are very distinct, risk return tolerances, and people tend to separate them. Battery, in fact, I came to Battery when they started doing buyouts, which for a venture firm was kind of crazy, unheard of. But they took a deep look after the internet bubble at the public market software businesses, and ended up doing one of the first software take privates back in 2003 of a little ERP business. And there was a very quick, very good return. Again, the risk return was very far off in their favor. I think they made a 5x in just a couple years buying a company versus an early stage bet. And so they said, hey, as software has matured, we need to figure out how our investment style evolves with that. And so again, kind of early days of mature software, decided to build out a team. And so I was working at a private equity firm in San Francisco, and they called me up and said, hey, we need somebody who understands financial models, who understands how to deal with debt folks, because we want to do more of these buyout deals. And would you move to Boston? I said, sign me up. I'm coming out. And my husband and I made the trip out to Boston, stayed there for a couple years, ended up coming back. But yeah, the rest is history. So we kind of evolved, I guess, as software evolved, the investment style, just because the fund enabled it to be so flexible. We had very flexible capital, and it's really stuck with us. We found that our returns it's really interesting. Some years, or in some funds, the early stage might be, far up, and, buyout is kind of level, right? And then it kind of flips in different years. And so it's enabled us to have this really interesting, consistent return profile. No kind of, 15, 20x funds, like some early stage, but we have really great returns across all of them. So it's a really interesting model. And it just, as from an investor, it allows me to see what's happening on the innovation side, because I'm a growth investor. I don't do early stage. I need data to make my decisions and have confidence. And so, but yet I can see what's happening in these early stage companies and make sure that I'm aware of that, so I don't make a footfall on a growth stage investment or a buyout investment. So it's an interesting model.
Do you find yourself competing more and more? I mean, like, where do you see valuations now? I guess is one way to ask.
My gosh.
A couple of years ago, it seemed like a lot of money was chasing deals that may not have worked out as well. Just curious to where you see things like now.
It is just wild out there. There is a lot of capital chasing very few deals. And so just because of that, valuations are still pretty frothy. It's kind of a tale of two cities, though, in that, we call them the A companies, the ones that everybody wants to be a part of, are still getting, I mean, maybe not COVID valuations, because that was really crazy, probably 3 standard deviations off of what was kind of normal. But it's certainly as high, if not higher, than 2019 valuations. And so those are kind of, stuck there. And then the kind of B plus to, B plus companies, a lot of those deals just aren't even happening. And so it's a really, really interesting market out there. It's hard to see in some of these, deals that are going for such big price tags, how people are going to make returns. I mean, that's kind of, we're all scratching our heads, right? But it's a wild market right now.
So we have a bunch of people turning in questions. Again, please keep them coming, and I'll sort of bring them into the discussion. One of the questions was about your thoughts on the US approach to AI. But maybe let me frame it slightly differently, which is that I guess Europe is a lot more sort of out front regulating things. So when you make investments, is that something you think about? Like, where is the company? Where is the market? Love to hear your thoughts on that.
Yeah, I mean, certainly given the global regulation of all software deals, especially on exit, right? We think a lot about that now. Not maybe we didn't a few years ago, but we're seeing regulators kind of across the globe get involved and say no to deals. And so I do feel like what happens in Europe is going to drive what happens in the deal environment in the US. for sure. And so they are out in front. I mean, we see it happening. I'll give you a small example. The security measures that they passed in Europe 5 or 6 years ago, that has impacted all of our businesses around the world, because you can't do business in Europe unless you follow them, right? And so it, global change or global regulation really has a massive impact.
Hmm. Do you do much in the way of like, is there an industry sort of group y'all are a part of to try to affect, let's say, the regulations in the US, or do you kind of stay out of that?
It's interesting. So we have a National Venture Capital Association, and I actually just joined the board. I'm going to DC later this week. So funny timing for my first board meeting. And we talk to senators and Congress folks, whoever will listen to us, I guess, and try to help them understand what's happening here and how regulations that they pass in Washington have a impact on the innovation and what's going on in startup land.
So I'll take some of the questions that are sort of coming in. For SaaS businesses, is the value proposition business model as important, more important than the founder, right? Sometimes you'll have people, VC say, oh, it's all about the people, and you say, no, you need data. How do you sort of play those off?
Yeah, I think it's a little of both, and it really depends on the stage. And so for an early stage investment, I would say, you've done your market work. You were, like I said, very product market focused. And so understanding if there's a market there, if these guys have the best product, then we're excited. But the founder, I mean, there's so much to go for. Can they really create a meaningful company out of this? There's a lot to go. We see pivots happen all the time. And again, like you really need to have confidence that this is the founder that's going to help you drive that. In the growth stage side, I think so much of that risk is you already know, right? That the numbers kind of speak for themselves. And so there's a little bit less risk there. Certainly the founder matters and the management matters, execution matters to stay ahead. And we have a lot of examples at Battery of companies we've invested in that were product market leaders at the time of the investment, didn't keep that because some innovator came up from underneath and came out with a better product and took them over. And so having the consistency, I guess, right, and that is founder led. But I think there's less of that risk at that stage than in the early stage. So it's both. It's always both.
And when you make the later stage investments, do you ever think, well, this could work, but I need to change the founder, change the directors? Do you ever do that, or do you just stay away from those companies?
Yeah. We'll consider them. I think usually what we see is, a founder might just be tired and is very transparent and saying, hey, I got it to this point, which was really hard. I mean, getting a business to 10 million and then 20 million, it's really hard to do. And, in some cases it'll take years. And so we've seen it a lot where a founder is just tired and says, hey, I'd love to do something here and transition out. Maybe I go to the chair. And for us, it's really understanding the importance of that founder and, how embedded are they in the customer relationships and the team dynamic? Like, is it really easy to take them out of the business? Sometimes, yes, it is. And sometimes it's very difficult. And we would pass on those deals. We like working with founders.
So we have a macro question basically saying, given that the Fed is going to start cutting rates, how do you see that changing, for example, the kinds of multiples you need to pay, or just the state of the industry over the next couple of years as we go into the cutting cycle?
I think it'd be really interesting. It's, certainly it impacts the public market multiples. We know that from COVID days now and ZIRP. And so I come back to, though, the money in the private markets and the competitors that we deal with. There's just so much capital out there. I don't know that the multiples increase beyond where they are. And so I don't know that it has as big of an impact in the private markets, but certainly we should see some impact in the publics. I mean, right now, private market valuations are much higher than public market valuations.
So sort of something related to that, when you think about the people that you raise funds from, have their expectations changed over time? Like what are sort of the expected returns they're expecting from you?
I don't think they would say that they've changed over time. That's the hard part. So yeah, I mean, everybody's generally looking for north of a 3x for our asset class. And I haven't heard that that's changed. The industry hasn't given that, right? But I think that's the benchmark that they're all hoping for when they go into a new fund.
And has it become, you're saying there's so much money coming in, has fundraising become easier, or do you just sort of increase the size of your fund? How do you manage that tension?
Yeah, gosh. So fundraising, I think right now is probably not a very easy time. And that is just a function of liquidity. And so, you know, everybody is acutely aware that DPI matters and getting money back to our investors matters so that they can put more money back into your next new fund. And so I think it'll be an interesting few years here because we're kind of at that point where the last couple of years have been tougher. I come back to our model, which is great in this time. We actually have great DPI and we're giving out more money than we're getting from them for our new funds, which is good. But that's not true across the asset class. And so it doesn't matter if we do it and nobody else does, right? The capital's not going to be there. So I think it's going to be a tough environment the next kind of 2 to 3 years. The other thing in the industry is pace has really slowed pretty dramatically. And so I look back at our last few funds and it's been, you know, we always try to get the dollars out within 3 years, maybe 4 years. And the last two before this, our 14 was 2 years. And that was hard. We tried to kind of keep it along. So, because there was just so much activity. Now, I think this fund's going to be a little over 3, maybe 4 years. And so we're not the only ones. Pacing is, I think I saw the latest report of, you know, folks are about 40% deployed through their 22 vintage. So it's going to take a longer time just because there's fewer deals out there right now. So folks will have money for a while still.
And just the composition of the people who invest in you, has that changed? Like, are you looking for new people or do you have sort of the same group that's come with you through this journey?
Yeah, we've been very fortunate in that we have the same base really since probably Battery 7. We oftentimes have slots for a couple new folks each fund, and we did have a meaningful increase. We used to have kind of $1 billion funds. We didn't want to go beyond that. The one before this most recent one, we doubled it to 2. We wanted to be able to do bigger buyout deals, and we had more deal doers. And then now we've gone up yet again to 3, a little over 3. And so we have expanded that. Now, as we expanded, some of our LPs did, and some just tap out. And so there was room for more.
So a couple of questions related to the comments you made. One is about AI, as you might expect. Just that, are there any litmus tests that Battery is using to think about, okay, you know, this sector is going to be a winner or a loser due to AI, Gen AI, something like that?
It's a loaded question. So I'd say, kind of coming back to first principles and figuring out where the equity value is going to accrete to. So there's the foundational models, all of the tools that should be developed on top to make those work, and then the application layer. I think our view is the foundational models, there's not a ton of differentiation that we see across, and they're very, very, very expensive. And so it's hard to see kind of the risk return. Maybe there will be, it'd be interesting to watch. We've chosen to really focus on the tools on top as well as the application layer. And, personally, because I've invested in a lot of vertical SaaS. So, software sold to physical therapists, software sold to dentists, software sold to real estate agents. And the view of, in a world of AI and Gen AI, data is the king. And that's how you differentiate. You have different data that nobody else has access to, right? And so I'm spending a lot of time with my companies that have that current position of having the data and being kind of the workflow leader in the space, and having them put Gen AI into their application. I really think the incumbents should win in a world of Gen AI where data matters. But there's a lot of niches that I was talking about earlier. As we get into cheaper and cheaper software, you can go into areas that haven't had any software. They're not automated yet. I think there's going to be a ton of Gen AI for those areas. So I think there's, even looking at consultants to come in and help my companies, right, as one example, put Gen AI into their current workflow. That's a great business. We've seen a few of them, not as many as I would have thought. But yeah, we're trying to look at this big landscape and figure out the next 5 years, the next 10 years, who are going to be the winners, who are going to be the losers. And it's a really it's tough. It's we're very, very early innings.
So one vertical you mentioned, which we had talked at the beginning, where you've done a lot, is healthcare, which is again an area which has tons of data, but also lots of issues with the data, right? Can you actually use it? Is it available? Love to get your thoughts on sort of how did you get into that, and broadly, and also where do you see AI playing a role in healthcare?
Yes, I think there's so many areas for making healthcare better. It's really tough. So how did I get into it? I grew up in a family of docs. And so I've just always been drawn to healthcare, I guess. When I got to Battery, they hadn't done any healthcare deals, which was surprising given it's, the largest part of GDP and probably the biggest laggard in technology. And so that's where I kind of, chose to spend a lot of time thinking through, where are the investment opportunities? And we landed on providers and late stage, because building an early stage healthcare software business is really, really, really hard, probably 10 times harder. I think at the time, this is 10 years ago now, but at the time, the data suggested it was 10 times harder than a standard kind of horizontal software company. So stay away from that. I don't think that anymore, actually, especially with Gen AI. There's a ton of really interesting areas to go after. But yeah, data, what we're seeing is there's so much data, and with the data lakes like Databricks, which is one of our businesses, Snowflake, the ability for these big hospitals and healthcare networks to pull all of their data from all the different EMRs. The EMRs don't necessarily have to talk to each other. They never did. I think it's hard for them too. But let's get all of that data into a data lake, and you can apply then Gen AI to that data lake. That's going to be super powerful. And all of the cloud providers are interested in a piece of that as well. And it's starting to happen. It's maybe a little bit slower than I would have thought, but it's starting to happen. And so I think that's going to have a pretty big impact on healthcare. And that's just kind of in the current data flow and, the where data is stuck today. But if you even kind of take a giant step back and think about how AI can help with drug discovery and scientific discovery, and it's just like going through the mass amounts of data faster, I think we're going to see some really interesting new developments across healthcare from that as well.
So let me add, one of the political things that's come up is that PE should not be investing in, healthcare in certain fields. I don't know if you have any thoughts on that.
Yeah, I mean, I think it's tough when we know PE is all about maximizing profit, right? By design. And when they're service providers, unless there's a lower cost of service, maybe AI helps with some of it. I don't know. Actually, I've seen some pretty interesting AI solutions for like memory care
Mhm.
providers. And so they can detect falls and help with that before it
Mhm.
happens, which is interesting. And so maybe you don't need as many nurses.
Right.
Um, but yeah, I mean, kind of seeing some of the examples that private equity has had in healthcare services specifically is not been, thinking of myself as ever being in one of those facilities. It's yeah, it's gosh, it's hard. So should it be regulated? I don't know. It feels like there are better ways to get to that place than just stripping out costs, though.
Mhm. So maybe slightly tangentially, one of the questions that came in was, do you think about the social benefits of your investments? Is that ever like a factor in what you do?
Um, I'd say I, after doing this for so long, I think about it now for sure of, where do I want to spend my time? Does it make me feel good about doing it? Or not? I probably didn't think about it early on. We're not an ESG fund. It's not something that we kind of, have at the checkbox of our IC, but I think all of us like to think about like what's the overall impact that our businesses are having to society. And yeah, I'm proud with a lot of the healthcare ones that I've been a part of and how they have had meaningful impact. And I do look out for that now. But it's probably more of a luxury because I can versus, had I been thinking about that at the start of my career.
Mhm. And so one of the other questions that came up was sort of speaking of deep dives, is climate tech something that y'all are thinking about? Do you even think it's a viable area for VC investment?
It's interesting. So we made some climate tech investments, gosh, maybe kind of late 2000s. It's a really tough space in that it requires a lot of capital typically, and there's so many different facets of climate tech, but thinking of like wind turbine technology, I remember we had this investment in this wind turbine company, and it took so much capital to build the turbine, to figure out whether it was even going to work, let alone if you could sell it on the back end and have product market fit. And so from a VC perspective, having to invest so much capital up front before you even have revenue is hard. Now, we used to do it in the old days before I was even here with semiconductors and telecom and stuff, but we've just kind of had this nice software land, and I think kind of got out of that way of thinking, of having to put so much money in before you actually get dollars out, and then it takes years and years. Most of us have kind of 10 to 12-year fund horizons, and these technologies probably take more than that, right, to really kind of work out. And so I think it's tough from a venture perspective to do that unless you had kind of longer term funds.
Mhm. That's super interesting. So maybe just slightly related to the turbine example, a question came up about how do you manage your investments that aren't doing as well, right? Let's say they're sort of, below whatever, 70th percentile, 50th percentile. What do you do at that point?
Yeah, it's funny. It's the dirty little secret in venture of, usually the worst investments take the most time. um, but I would kind of separate it out. We've just, given our 40-year history, have been pretty disciplined with most of our processes, and this is an area that we spend a lot of time kind of thinking about. And so our follow-on investing process, for example, we have a really unique investment decision process where the first dollar's in, it's really the deal team. We go through the investment committee process, but the real deal team is the one who makes the no decision. And it's really just the IC process is an intellectual debate, and to make sure that we've thought through everything. It's a great process. But then on the follow-on, that's when the IC makes the decision to make sure that we're not putting bad money after good, or good money after bad, rather. So we, because of that, have pretty low loss rates, kind of less than 15%, which is good. So we don't spend a lot of time on the ones that aren't going to work, but I go back to, you have to separate in, are they not working because we got the product market wrong, or because the execution is wrong? If it's execution, you can fix it, and we've had those. Those take a lot of time and a lot of energy, but we fight for every dollar back. It's the product market ones, when those are wrong, it's just almost impossible to kind of pivot out of that. Sometimes it happens, but we try not to spend a ton of time on that.
There's a question about just like a broad picture. I mean, you've been in the private markets the whole time. The question is, are you concerned that there are greater systemic risks associated with financing via private markets compared to traditional public markets?
Am I concerned with the risk?
Yeah, that you feel like somehow, like from a systemic standpoint, if money is not in the public markets, if it's all being done through private investments, that somehow creates the risk in some sense.
Interesting. Yeah. Lack of information, maybe. I haven't probably thought about it enough. It does certainly feel like we're going that way. There's just another take private example today of smart sheets. And so I feel like so many, because the public market valuations are lower than private, we're seeing more and more take privates happen. And so pretty soon we're going to end up with even fewer public market companies. And you talk to public market investors and everybody is clamoring for software companies. So you say, well, why aren't there more IPOs happening? And, meeting with a bunch of bankers recently, there's a very large pipeline of software IPOs that at some point, some of them will get out. But yeah, I mean, it's this really interesting time right now, where it is such a disconnect, and, it'll come back. We've seen the cycle, at least twice since I've been doing this. And so it'll come back. It's just hard to really know when.
So if it's okay, I'll shift a little bit. So some of the questions are about sort of your background, and are there things that you learned at Booth that have been particularly sort of useful to you? So let's start with that.
Oh gosh, this is a time machine going way back. Yes, there were so many classes that were pretty foundational for me. I remember Schrager's, I think it was called New Venture Strategy at the time. That was very impactful, and I still use a lot of that today. What are the best strategies versus the least likely to succeed strategies. So that has definitely helped me along the way in looking at different business models and thinking about kind of first principles there. All of the finance classes were great. I did Ellen's class of the internship. I don't know what you call it now, where we went for over the summer, we did an internship with some at venture firms, some at startups, and came back and had a class on it.
These are the lab classes that Ellen Rudnick started.
Yes.
Yeah, the PEVC lab. Yeah.
Yes, that was incredible. There's so many that were really great, and kind of the ones that I gravitated more towards were probably the kind of hands-on, the case study ones. I mean, those are the ones that I still remember, and so were very impactful.
And so then, as you look at your journey, so I guess sort of a twofer. Are there things you would have done differently in retrospect? Is one, and the other is sort of what sacrifices have been the most challenging on your journey to becoming a general partner?
Gosh, wow, good question. So would I have done something differently? I just looking like going back to my classes, I wish I would have taken um, negotiation. I don't know why I didn't take that class or many classes on negotiating because I do it all day, every day. It would have been really helpful. Um, but so that's certainly one that I feel like I missed out on. Other than that, I don't know that I would have done anything all that differently. I think I had a pretty solid path. I've learned so much along the way. I did PE right after Chicago for 3 years and just learned so much about pricing risk. I mean, it's down to the pennies. Like our models were very, very precise, probably not accurate, 5 years out, but just a lot of learning there that has really helped me here. Um, so yeah, I don't have too many regrets on that front. On the what have I given up? Um, I tell the junior team this a lot. I mean, I do feel like I have, focused so much time and energy on building this career and proving to myself and everybody that I could do this. And probably, at the expense of some friends. I can't make it to all of my kids' soccer games and lacrosse games, and but I'm fortunate to have a husband who is there and can do that. And so there's definitely been trade-offs along the way, no doubt. Holidays I've missed, vacations I've missed. I think that's probably true of so many different professions that folks at Booth are going to be thinking about. And so it's not particularly different here. But yeah, I mean, that would I change it? I don't know that I would change it. I think it's made me in many ways a better mom, because I've learned that when I am home, I'm present, I'm very present, and I want to, be a part of everything that's going on. And vice versa. I think I really figured out how to manage my time when I had kids much more effectively. I used to say yes to everything and go to every single conference and go to every meeting that I was ever invited to. And now I'm very, you have to prioritize. You're forced to prioritize, and I say no.
Mhm.
So I think on both sides of the coin, I think I've just become maybe a better person.
Mhm. And so we had a question that came in about, VC has historically been very, very male dominated. Was it very difficult for you to successfully carve out this place that you have?
Yeah. Gosh, I think I could write a book about this. But
You should.
that's for a different day. That's for a different day. Um, yeah, I mean, look, this is one of the most humbling occupations out there. I think you can do all of your work and pick the right market, and then maybe the wrong product or the wrong team, or there's some crazy HR issue. I mean, remember, software is humans, and there's always some crazy HR issue going on, like all over the place. Or you can pick the right product market, the right company, exactly the right company, and you get there, and 20 other investors are knocking on the same door. And so it's just so competitive that even when you have it right, you've picked it right, it's really hard to get in.
Mhm.
And I had a ton of doors slammed in my face, for sure. But you learn how to persevere and get over it, and it makes you stronger in so many ways. I guess I'd say that in many ways, I became better. I figured out that like what skills I had and what was different that I had that could differentiate me and help me win a deal. Just a really early example, Battery is a very outbound sourcing culture. And so you get here, you eat what you kill. You go and you find deals, and then you bring them back. And so, straight out of school and then private equity came in, and basically I could call any company that I wanted to. And what I learned was my cold calls into, because we were on the phone, we weren't emailing all these companies. We were on the phone at the time. And what I learned was my cold calls got more callbacks than all of the guys. Like, oh, that's really interesting. What's going on? And what I learned was there were just no other women calling these companies. And the CEOs were like, I kind of had to like talk to you myself and figure out what the heck's going on here. Because I don't get any women calling me. And so that's an advantage, right? I can get in. And so again, you kind of learn where your advantages can take you, and where to focus your differentiation to win deals.
That's a great answer. We had a career question about like when you hire people, do you look to hire only people who've already had experience in PE or banking, or would you look at somebody who has a tech background and is trying to sort of get into the field?
Yes. So we've changed actually pretty significantly the last probably like 6 or 7 years. And we wanted to have a more diverse representation. And so we started recruiting people right out of college, which is kind of crazy. I don't know if I would have done well right out of college in this world. But it's worked very effectively. So we bring them in and we train them. We have analyst class every year. They just started 2 weeks ago. And so, yes, we are getting all sorts of backgrounds, econ degrees, history degrees, engineering degrees, computer science. I have a partner who loves computer science backgrounds. And so, yes, we are becoming much more, I guess, open on that front versus it used to be just going to investment banks. And that was the background. So.
Great. Couple more career advice questions. One is advice on how do you go from the operations side, in this case, like fund accounting, to the investment side? How easy or hard is that?
Fund accounting. I think like anything, it's do you really want to do this? And if you do, you likely have a thesis, an investment idea. And so it's about reaching out to your network and telling them. Some of the best emails I get are, hey, Chelsea, I have this really interesting idea in XYZ space. Here's my market map. I'd love to spend 15 minutes with you to talk through it. And if it's a really interesting idea, I talk to them, right? It's I guess a better way of saying it is test it out by actually doing it and making sure this is something that you want to do, and use your idea to get your foot in the door. Because chances are, like if you send that to people, they're gonna give you a call back, at least give you a look.
So personal question, what is the best piece of advice you've received in your career?
Oh my goodness, that's a tough one. I had so much advice. I'll tell you, one that was probably the most impactful. It was a company, actually, one of my first investments, a company called Guidewire Software that sells into. They're actually still public. Great company. They sell into the insurance space, and so they did start out with claims management software. And I was a senior associate. This is very, very new days at Battery at the time, and I was partnered up with Neeraj Agarwal, who's an amazing investor and great mentor to me. He hired me, actually. And we were doing our diligence. I was asking all of the questions. And the woman, co-founder, was the CEO. Priscilla is her name. She's great. Pulled me aside after one of our diligence sessions and said, hey, can I take you to lunch? I said, I don't know if I'm supposed to go to lunch with you. We're doing diligence. And so she's like, no, I need to talk to you. And so we went to lunch, and she said, you are, I can tell, really sharp. And you come across as way too young. So you need to have a different tone when you speak. You need to dress up a little bit, and you need to speak up. And I'm telling you this as a woman who's been there, done that. And it's crazy to say, but the fact that she did that, like gave that to me, the criticism that I needed, but like very helpful. She didn't know me really. I've had 2 meetings with her. And that to me was just, nobody's had more of an impactful kind of advice. It's not like your high level advice. It's very tactical stuff that I could actually change. And that she cared enough to do that, I thought was pretty incredible. We're still friends today.
That's great. Now, you've been at Battery a long time, and clearly you must have had lots and lots of opportunities. Sort of what keeps you at Battery?
Yeah, it's one of those things that a lot of folks end up starting their own funds. But I'll tell you, I come back to what I mentioned earlier. The way that we make decisions here, it really is like I have my own firm, right? Because I get to make my own calls and where I spend my time and where I invest. And yet I have this collaborative environment to debate all these topics with really smart people. And so it's kind of the best of both worlds. So that's, I think, frankly, what keeps all of us here still. It's a great culture.
It's kind of related, a great question that came in. Says, you've reached amazing heights in your career and you're an expert in so many things. What keeps you waking up in the morning to take on the world and new investments?
I just love it so much. It's, I think it's such a lucky position to be able to work with such passionate people building these companies. And every day is different. I'm learning something new every single day. It's just, I don't know. I don't think there's anything else that I would love to do. It's so much fun and I learn so much.
That's a great answer.
Keeps me up. Yeah.
And so listening, we have, sort of current students with lots of different backgrounds. Some of them want to be entrepreneurs. Some of them want to get into finance, investing. Would love to have like any advice that you want to give to them as sort of your last words to them.
Oh gosh. Finance investing. Take Kaplan's course, definitely take some entrepreneurial classes as well. It'll help you get in the mindset of the founders and CEOs that you're going to be working with. And so I think that's important, and probably vice versa. Entrepreneurs, you guys have such an advantage right now in so many different ways. It used to be the case where the investors had the advantage and we could pick who we wanted to invest in. That is not the case anymore. The tables have turned. And so, yeah, the world is your oyster. There's just so many exciting opportunities out there right now.
So Chelsea, thank you for taking the time. I know you're very busy and you're, again, just to reiterate what the question said, you've had an amazing career and we're incredibly proud to call you an alum of Chicago Booth. Thanks for taking the time to answer these questions sort of super transparently and in a manner that I think our audience really, really values. So thank you.
Thank you for having me. Glad to be here. Take care.
Thanks, everyone. Bye.